My name is Brittany Wallace. Today I will be doing a presentation on ratio analysis on the oil and gas industry as well as the airlines industry. Now, first objective is to pick two industries, like I said, oil and gas and airlines industry. The second objective is to pick the best company from each industry as far as the best investment. Now, the last objective is to pick between those two companies and choose your best overall investment. So we're going to be talking about the liquidity ratios, leverage, asset management, profitability, market value, supply chain, analyst recommendations, and the dividend discount model that is in Bloomberg. For the airlines industry, I am looking at Alaska Air Group, American Airlines, Delta Airlines, Southwest Airlines, and United Airlines Holdings. This is just a supply chain of each company. As you can see, there are no listed customers because each company's customers are just individual consumers. You will see here though that their suppliers range between about 10 and 20. Now first we'll look at solvency as an industry. As you can see here, on average the industry does not hold enough assets to pay its debt obligations. The leverage as an industry, they have a pretty constant amount of leverage. We have a little peak here, but it's pretty constant overall. Their ability to repay their debt obligations, is very, very good. They can pay it many times over, as you can see. Now this is the asset turnover ratio as a whole, an industry average. And as you can see, they're below 1 every year. Not very efficient in turning over their assets. This here, the white line you see, is the S&P Airlines Industry Index. As you can see, the other companies are pretty much in line with their index. This red line up here is Southwest. Their price is a little bit higher, and as you can see, their movements are fairly larger than the industry index. First, we're going to look at solvency. This is the current ratio. Southwest, as you can see, is the most liquid of them, and overall the most consistent. Now let's look at how much debt these companies hold. As you can see, the yellow line is Southwest, and we have Alaska down here, and Delta, the gray line. They are pretty consistent. Now United has had a decrease, but as of about 2016, they stayed pretty consistent. American, on the other hand, spiked. Let's see, about tripled in 2 years. So that could be something to be concerned about, depending on whether or not they can repay that debt obligation. Now here's the time interest earned ratio. This ratio tells us whether or not they can pay their debt, how many times over they can pay their debt. As you can see, what is this? United and American, pretty consistent. So if we look at the slide before, American is the one that tripled their debt, but they stayed consistent in repaying it. So that's not something to worry about. Southwest shows a little volatility here. However, they are significantly higher than the others. And you'll see Alaska here, the dark blue line, they have decreased their ability to repay their debt over time. Now if we look at profitability, we have some spikes here in 2015. I would say that it's probably due to the decrease in oil prices. So that decreased their expenses and obviously made them more profitable. Let's see, Southwest again shows increasing is higher than all of the others. So Southwest is looking pretty good right now. Okay, if we look at each company's ROE, we're going to do an ROE decomposition and see what's driving that ROE. You'll see that American and United spiked right here in 15. We're going to see what caused that. Everyone else stayed pretty consistent. All right, and if you remember that spike in 2015, looks to me like that came from tax burden. We're going to look at a few other things and see if those might have affected the ROE. But right now, I'm looking at that tax burden. Interest, as you see, pretty consistent. Here in 2015, equity multiplier is consistent. EBIT margin is fairly consistent. A little bit of a peak, but I wouldn't say that's what caused the ROE to go up. And total asset turnover, again, consistent. All right, next we're going to look at the dividend discount model. This comes from Bloomberg. So we have our closing prices for each company, our theoretical prices according to Bloomberg's dividend discount model, and whether or not they are undervalued or overvalued. So according to the dividend discount model, all of our companies are undervalued except for Southwest. They are said to be overvalued, looks like by about $13. All right, I thought it would be very interesting to look at the effects of the Boeing crashes on the airline industry. So this percentage cost to the company, that comes from their total cost, a percentage of their total cost that they spend on Boeing planes. And then the planes happened in the last quarter of 2018. So I looked at the difference between fourth quarter 18 and first quarter 19. Now the percentage change in PM is the percentage change in profit margin between those two quarters. As you can see, the lowest cost was Delta, and they also had the lowest change in profit margin. Now what I thought was interesting was the fact that Southwest has the highest cost. I believe about, let's see, 90%. And they decrease, let's see, third, but very small compared to their total cost. So they handled that event very well. All right, next we're going to go on to the oil and gas industry. Now for the oil and gas industry, we're looking at Conoco, Chevron, Phillips 66, Occidental, and ExxonMobil. Okay, again, these are their supply chains. Few of them have one customer, but their suppliers they vary a little bit. Okay, let's look at the industry averages for solvency. Our industry averages, pretty good, pretty constant, and they are above a 1, so they do show that they hold enough assets to pay their debts. Now, when we look a little bit further, we're going to look at one company who is significantly lower than this industry average. Okay, next we have our leverage. Leverage, again, stays pretty consistent. However, ability to repay that debt tanks right here. Starts to go back up, so they're getting back on their feet. This, you will see a trend of 2015 and 2016 being significantly lower than the other 3 years. That is due to the decrease in oil prices. I believe oil decreased to about $35 a barrel, anywhere between $35 and $40 a barrel, which is extremely low. Okay, if we look at our industry efficiency averages, they're pretty volatile. Again, you see that low point in 15 and 16, but they are making their way back up. They're recovering from that. This is just a graph of the industry index. This comes from the Dow Jones Oil and Gas Index. The white line is that index. If you look, they are, again, pretty consistent with the index. This red line up here is Phillips 66. Just like Southwest, they're a little bit higher and their movements are a little larger. Okay, let's look at the current ratio for the oil and gas companies. As you can see, Phillips 66, the most constant right here. The others, Exxon is constant, but like I told you before, Exxon is the one that does not show that they hold enough assets to repay their liabilities. Okay, how much debt do these companies have? Again, they are all fairly constant, so debt wouldn't necessarily be something I would worry about with this industry. Now, their ability to pay debt is a different story. As you can see, Occidental tanked in 15. I'm gonna relate that to the oil and gas prices. They did not deal with that event as well as the other companies did. You'll see Exxon, a little volatile with their ability to repay debt. The others are pretty constant though. Now let's look at their profit margins. Again, we see some tanks in 15. These three up here, pretty constant. They dealt pretty well with that decrease in oil prices. Okay, just like we did in the airlines industry, we're gonna break down ROEs to see what's driving the numbers. We have these huge dips for Occidental and ConocoPhillips. Some small dips over here. This is for Phillips right here in 2016. Okay. If we look at 16, tax burden went down a lot here. Little bit of interest burden here. These two things are things we can't control. So we're gonna look at some things we can't control. Now the EBIT margin, right here, you'll see these dips. I'm gonna say that's what drove those two dips in ROE. Equity multiplier, again, leverage, that's constant. Got a little bit of a dip in Phillips, their efficiency right there. So I'm gonna say this is what drove the ROE dip in 2016 for Phillips. All right, we're gonna look at the dividend discount model again. This is for the oil and gas industry. Like I said before, closing price, theoretical price according to Bloomberg's dividend discount model, and their value. So it looks like we have Conoco, Chevron, and Phillips 66 as overvalued, and we have Occidental and ExxonMobil as undervalued. Now, after going through each of these ratios, comparing them over time, comparing them to each other, my two top picks were Southwest and Phillips. So now we're going to compare those two companies to each other. Okay, if we look at the current ratio, right here, the top line is Phillips. They show a greater ability to hold assets that will repay their debts than Southwest does. If you go over to leverage here, we have Southwest with more leverage than Phillips. Now, that in itself doesn't necessarily mean anything. Let's look at their ability to repay that debt. Again, Southwest has a much greater ability to repay their debt than Phillips does. If we look at our efficiency measure here, Southwest, while it is lower than Phillips, it is constant, while Phillips is a little volatile there. Okay, let's look at our ROE, our profit margin, and our EVA spread. Now, the ROE, you see that Southwest is indeed higher than Phillips. If you look at profit margin, Southwest, again, higher than Phillips. They're both a little volatile there. And if you look at EVA spread, Southwest is, again, higher than Phillips. Again, both volatile. Phillips, huge sink right there in 16. Okay, let's look at the PE ratio. So Southwest is pretty consistent. They had a little bit of a dip here, but from 15 to 18, they've showed some consistency. While Phillips has gone up, down some more. So volatile there. We're gonna look at what's driving these numbers, because this can mean one of two things. A low PE can either mean that the stock is undervalued, or it can mean that earnings are just significantly higher that year. So we're gonna look at that. Okay, this is the PE breakdown for Southwest. And let's see, the price per earnings ratio is the green line. The white line is the last stock price, and the earnings is the pink one. So as you can see, higher PE, earnings are lower. So I'm going to say that the price is driving that. But if you go over here, you've got a low price per earnings ratio and high earnings, higher earnings. So I'm going to say that in the last bit here, earnings are driving that low PE ratio. Again, let's look at the same thing with Philips. We've got the earnings higher here with a lower PE ratio. So again, I'm going to say earnings are driving that. If you look towards the end, price per earnings is going down like we saw in that graph. And the earnings are way up here while the price is down here. So I'm going to say they had some higher earnings and that's what's driving that PE. Wouldn't necessarily say either one of these companies are undervalued. Here we're going to look at the analyst recommendations here. So for Southwest, it's kind of all over the place. Looks like we're about half and half for buys and holds and about 8% for sells. Now, if you look over here at Philips, no sells, 70% buys and 30% holds. Okay, this is the stock price over the past 5 years. As you can see, Southwest is much higher than Philips. Philips is down here, but we're not going to just look at which one is priced higher. We're going to look at the growth. Southwest has 146% growth over those 5 years, while Philips only has 13% growth. Okay, and I was thinking to see what kind of correlation these two companies had, whether they would be a good hedge or not. So I ran just a quick Corel function in Excel, came up with a positive correlation here, which tells me it would not be a good hedge. They're positively correlated, they will move together. Now it's not necessarily the strongest correlation in the world, but it is still strong. I mean, it is still positive. So while thinking about what could have made that positive, I came up with the fact that oil, like Philips, oil prices affect airlines like Southwest. So I decided to run a quick regression on Philips return and Southwest return. Now I use Philips return as the independent variable and Southwest returns as the dependent variable. And what I came up with here in my regression is that, again, the coefficient, positive coefficient, not necessarily very strong. However, it is statistically significant that Southwest returns do move positively with Philips returns and are somewhat dependent on them. So I thought that was very interesting to see. Now when I pick between these two companies, seeing all of the ratios, seeing how they converse with one another, I decided to go with Southwest. Thank you so much for your time. I hope you enjoyed.